Hello, hello everyone. Hello. Hi, this is Charlie Tian. If you don't know me, this is Charlie Tian. I'm the founder and CEO of GuruFocus. And I'm very glad, very happy to be up here again and meet our users, meet you. And I already see some familiar names. Yeah, tell me where you are and how you are doing. I'm based in Plano, Texas, which is actually the Dallas area. Plano, Texas. And at early November, the weather here is great. We're in perfect weather, not hot, not cold, and not windy, not raining. It's sunny. It's perfect actually. And tell me where you are, and I will. I'm very happy, very glad to hear from you. Okay, already see quite some familiar names, and as always, feel free to ask me any questions. I will be very happy to answer any questions. I'll do my best, and I may not be able to answer every question you have, but I will certainly do my best to answer your questions regarding to the market, regarding to how to use GuruFocus. And hey, very glad so many people are responding to my um, hellos. Yes, and we all know that the market has been up a lot, and especially the tech stocks, the AI related stocks, no matter it's in the AI business directly or indirect business, indirectly. And as long as they are related to AI in some way, they're up a lot this year. And so I want to review the market valuation at the beginning. And I don't know if your stocks are doing well, and are you worried about the market valuation at this point? I myself is kind of worried. I feel that um, the companies with good growth, the AI related stocks, technology stocks are all very expensive now. And on the other hand, we are able to find some good companies in more traditional industry, but their stocks are published, have been published this year. And that is the situation. Yeah, Thunder. Yeah, thank you. It's very hard to find good companies at good prices now. I agree with you. It is very hard, and my feeling is actually similar to what I had in 2001, before the market downturn in 2002, and about this time in 2001, I feel the market was overvalued. I couldn't find anything, and yeah, market did poorly in 2022. Um, okay, let me share my screens with you, and so that we can have a good look of where the market valuation is. Um, as long-term users probably know that we built this GF value page, GF value feature for SP 500, and if I open this page bigger, and the blue line is SP 500, the black line is where we think the fair value of SP 500 should be. And if you look at the percentage, the market as measured by SP 500 is now at the highest level since we have this chart. This chart displays. And a similar chart for NASDAQ is here. It's actually all under the market manual. And the one I just showed you is under GF value for SP 500. It's actually this chart. We have a similar one for NASDAQ. NASDAQ 100, and it's here. And if you look at this NASDAQ chart, it's even more overvalued. It's just reached the level that relative to the fair value, it reached level that had never reached before. And it's just so overvalued. And of course, we can take a look at the Buffett indicator. The Buffett indicator is measured as the total market cap over GDP, it's now 223%. 223%. It's unbelievable. It's if you look at this chart, let's look at this Buffett indicator ratio chart. It's actually this one. No, this ratio is here. If you look at all the data we have, and what we have now is much higher. The Buffett indicator is much higher than it was during the tech bubble in 2000. It's actually much higher than it was. And I remember Warren Buffett said that if the ratio is very high to a certain level, I forgot exactly how much he was talking about, like 150% or something, you're playing with fire. And now we are talking about much higher than that. We're talking about 223%. And so the market is playing with fire. And that is where we are. And if we look at the Shiller PE, which is another way of measuring the market valuation, it's called Shiller PE, market valuation, and which tells us similar thing. Buffett indicator, the Shiller PE. If you look at the Shiller PE ratio, and it's actually here, Shiller PE, and it's 47.7 higher than the 20-year average of 27. If you look at the long-term chart, this chart has a history of more than 100 years. And during the bubble, before the Great Depression, it was not as high as it is now. And it was higher during the tech bubble, year 2000. And now we're actually reaching that kind of valuation. So the valuation is very worrying. And the stocks mostly overvalued to me. And okay, let me show you another page we have. I will come to the questions. Yeah, feel free to ask me anything there, and I will certainly come to that and answer your questions. We created another page called Major Market Index Performance. It's under the market link, and it lists all the major market indexes. And here I use the example of SP 500. It shows you performance. It shows you the year-to-date best performer. First one is Robinhood. And let's take a look at Robinhood. We all know what Robinhood does. It provides a trading app for mostly young investors. And the valuation is just outrageous. The P ratio, 72. Okay, let's not talk about the P ratio. The price to sales ratio. The price to sales ratio is now at about 37. So the price to sales ratio, for every dollar of the revenue from Robinhood, the market gave a $37 of valuation. And the growth of the company is not that high. If you look at the growth is actually not that high. It's about 25%, 24% a year. If you look at future growth, and it's about 24%, and the earnings will grow about 15-16%. For this kind of company, and the market assigned a price to sales ratio of 37. It just doesn't make sense to me. It just doesn't make sense. And lots of companies, almost all the companies in this list have a very high valuation. Another one, Palantir, it's a hot stock also. And the valuation is, if you look at the valuation, the price to sales ratio is 122. So the price to sales ratio of this company is 122. It's just unbelievable. And it's just how can we justify this kind of valuation? How can we justify that? And it's It's just unbelievable. It's unbelievable. Okay, that's where we are with the valuation. And yeah, I saw someone's talking about the new features. If you want to learn about the new features we have, it's all under the changelog here. We listed here, and I'm sorry, we may not. You may have different opinion to Gupta. You may have a different opinion, but we may not always agree with you. And but we do work hard on improving our website in the way we think that's necessary, and also in the way from the feedback from lots of users. And yeah, we are traditional. We don't change that fast. We're more traditional. That's true. Okay. One, we added the analyst rating to the stock forecast page. We also added daily stock price target, and under this page, which is here. If you click on that page, it's under daily price target. Daily price target here, and you can it's analyst analyst page. We if you want to look at the stock forecast page, we actually added the analyst. This page is not getting very long, getting really long, and the analyst estimate change is at the bottom here. Okay, I think we added a link here, so you can just jump there, and that's where we are. Yeah, we work hard on it. Okay, let me look at the questions. Let me look at the questions. And okay, Arthur, I understand your frustration, but if you're not satisfied, you can talk to us. There's no point of complaining on here. It's not helping. I'm sorry. It just doesn't help. Just like you did with a teacher posting 20 times, it just doesn't help. We want to work with you, but if you just do this way, it doesn't help. Okay. Okay, I saw a question. Dark Spy. Do I recommend using GF value or GF value rank, which is more accurate to access fair value? And that's a good question. We have this GF value here, and we tell you it's overvalued and it's undervalued, like here. And but I think we did lots of backtesting. The backtesting results tell us the GF value rank here is more important, because when a stock is undervalued, when it's way undervalued, it doesn't always mean it will go up. There might be other reasons for the undervaluation. Lots of times the market is correct on things. Actually, lots of times it's just Arthur, again, please submit ticket for that. It's not useful if you just complain here. And sorry about that. And we do work carefully with our customers. And if you really want help, please follow our way of doing it. Yeah. Okay. Yeah, the dark spice. If it rank like a 10, always better than 9. I'm absolutely, yeah, statistically, yes. When it's ranked at 10, it's better than 9. We have a page for every stock. We have a here actually GF score. We have question mark here. If you click on here, and it tells you actually, you go down. It explains you. If you come down, and every in very detail of the backtesting and ongoing test results of the valuation of every factor we're talking about. every factor we talk like that and show you the back testing results and everything. And that's where you will find the results. Okay. Let me look at other questions. Rafael is asking, what do I think of Anfonel APH? I think someone asked this question before, and I'm certainly not familiar with it. And the stock did really well. Stock more than doubled this year. Valuation seems to be high, and yeah, the company seems to be profitable. P ratio 46, PS ratio is should be here. PS ratio 8. Yeah. Let's see what the company does. Okay, global supply of connector sensors, interconnect system. Okay, I think I know what it is making. It's more like an industrial product, very traditional industrial product. And the stock has been doing really well this year. Yeah, even actually long-term 3-year, it has been doing well. And the 5-year, it has been doing well. Yeah, I think the valuation seems to be stretched. Valuation is to me valuation stretched, but the business seems to be doing pretty good. It's a very consistent, predictable business. We have a predictability rank of 5 to it, so it's a very predictable business, and the growth is good. The future growth 25%. That's actually very good. And company profitability is great. The only thing, yes, is concerning is the valuation. Seems to be more overvalued at this point, and everything else looks to me not bad actually. Okay, Darren asking, from valuation standpoint, what do I think of current Shiller P ratio of Shiller P ratio stock compared 10-year average Shiller P ratio? Yeah, that's we have a page. The page should have it. If we look at the Shiller P ratio, okay, at all-time average, we have here all-time average. If you look at 10-year, okay, we should have a all-time historical value, historical average, 10-year average. Yeah, even if you look at 10-year average, 10-year average is about 33. I would say about somewhere here, around 33, and the current valuation is still much higher, and it's certainly at the very high end of a historical valuation, and it's certainly like that, a very high end of valuation at this point, and. Yeah, and okay, let's see another stock here. MTY. Probably Mighty Food. It's a Canadian company, and let's see the summary page. The Canadian company. Yeah, financial strength not so good. Profitability is okay. The growth. Yeah, company has no growth. That's probably one of the reasons that the stock has been doing. Yeah, the company, I would say it's not a very high quality company. Just look at the historical business performance. The revenue, yes, is growing, but the profitability doesn't grow with the revenue. And seems like the profitability is getting worse in last few years. And in this kind of situation, usually the stock does not do well. You need to have both revenue and earnings do well for the stock to do well. So that's so I'm not surprised. Also looks like the company will not grow much for the future. It will be the revenue seems to will be flat. In this case, yeah, stock will not do really well. Phil, thank you very much for your comment. Yeah, I think we have a very high reputation on customer support. And I know people like Arturo still not happy with us. Not sure. We're actually not sure what he really wants. He keep complaining, and but he doesn't communicate. And so, yeah, thank you for the comment. And we our support team is very effective. And when we see the ticket, I actually personally go through most of the ticket myself. I may not respond a lot of them, but I do look at them and discuss with our developers and our team. Okay. Sander is asking more time frame in the most broadly held portfolio chart. Okay, 5 years. Okay, most the model portfolio. Probably you're talking about the most broadly held model portfolios here. This one, it's this one. Model. This is actually the broadly model portfolio chart. The chart is since 2006. That's all the history it has. This red line, red curve here, and this portfolio has been outperforming the market most of the years over the last 20 years now, and outperforming about 2.7% since inception, 2.7% a year since inception. But this year it does underperform. This year, one of the reasons that this portfolio is underperforming this year is because it does not help as much as technology as SP 500, and it has more traditional industries like financials or service industry. So it does not didn't do as well as SP 500, but historically over long term, it has been doing very well, actually very satisfying. Okay. Second NY, two NYs talk about Lululemon. Lululemon, I think it's one of the worst performing stock this year. One of the worst performing stocks this year. Unfortunately, this year it's down. It's down. Okay, more than 50%. And the reason is because the growth just slowing down so much for the company. And it used to grow like 20%, 20 something percent. But now we're talking about maybe 5% growth in the future. So the market, there are lots of competing product, and as it getting more mature, the product that more matured, it's probably become saturated. And yeah, the future growth is concerning. That's a problem with fast growing companies. When it's growing fast, the valuation is very high, as measured by P ratio. Let's take a look at the historical P ratio of Lululemon. Historical P ratio, yes. Lululemon. Let's look at last 20 years. Last 10 years maybe. Okay. If I remove this price chart, yeah, when it was growing fast, you can see that the P ratio, the market assigned very high P ratio, but then when the growth slows down, and the market will punish it heavily, very heavily. That's actually here. I recommend you to read the book by Peter Lynch. His book "One Up on Wall Street" and "Beating the Street." They talk about things like this. When a fast-growing company loses its growth steam, growth speed, it's getting much slower, and the market will punish it dramatically. So the P ratio shrank from like 70 to now it's 10. So in this case, of course, the stock will do poorly. And of course, we also need to worry about the profit margin in this case very, very much. We need to we need to check if the margin is stable, if margin is declining. And when the margin is declining, that would be even more concerning. But at least it seems like Lululemon margin is stable in this case. If you look at the trading 12 months margin, seems like both the gross margin and the operating margin, this green line is more operating margin, this red line is the gross margin. Since the margin are stable, so maybe it's not that bad. The market is just punishing it for the growth slowing down. That's what I think. Okay, Chris is asking Howard Hughes. Howard Hughes, I'm not familiar with it. I know lots of people like it. It's I think remember it's a spin-off from somewhere, a real estate company. Let's see what the business. Okay, it's managed commercial real estate through U.S. It owns, manages, and develops commercial and residential real estate in the U.S. Okay, it's a real estate management company. I usually don't like this kind of company, and I think it's an industry that I don't feel comfortable and I don't really like. And the company doesn't have much growth, seems like. The future growth is slowing down. Historically, the market, it's very cyclical or it's very unstable, unpredictable. Both the revenue and the earnings are unpredictable. It's highly leveraged. And I really don't like this kind of situation because it's just not growing and it's not predictable. And so it's not something that I like. I like to invest. Okay, James asking about Progressive, PGR, Progressive. I think I like Progressive itself. It just I think it's a great business. Like Warren Buffett said, it's a great business. It's even better than Geico. Although Warren Buffett owns Geico, and he thinks that it's even better than Geico, and I will trust him on that. And but the stock has not been doing well this year. Just like Berkshire itself, Berkshire, and actually one of my stocks is called Brown, and it's Brown. It's an insurance agency stock, and it was, and just like Berkshire, it was doing really well first few months of the year, but then it stopped. It just first few months of the year they do well, but then they lost fever, and Brown lost even more since then, and it's one of my biggest holdings. But I think the companies are quality are good, and the growth is there, and but the industry as a whole is just out of favor. This industry is just out of favor. It feels very much like year 1998, 1999, and the previous tech bubble. The tech stocks were booming, but the traditional industries were hurting so much. The stocks were hurting so much. They're out of favor. They're not AI related. But on the other hand, the valuation is getting much more reasonable now. And Progressive are talking about a P ratio of 11, a P ratio of 11. So it's for someone who has patience. And the stock dividend yield is not bad also now, 2.34. The SP 500 has a yield maybe just 1%, 1.1, 1.2%. So it's for someone who has patience, who can hold through this market bubble. I would say it's a bubble, tech bubble, AI bubble, and it's for those people. And I think I'm I'm one of those people. And Progressive, I think it will do well over long term. It will do well in 3 years. I'm pretty sure it will do next 3 years, 5 years. It will do pretty well, just like it did previously. And previous 5 years, even with current downturn, it was still more than doubled, and I think outperformed the SP 500. Although this year it's down quite a bit, and it's down 12% something. But I think it's for those who has patience. Okay, and NVO, it's a drug stock. This stock it used to do very well too, but this year again, a few factors. One, of course, competition with Lilly, and the other is the market. Is also this is out of favor, and compare with Lilly. Let's compare with Lilly, and if we just look at this year, yeah, Lilly is doing better recently, and NAO is still not doing well. Between them, I own Lilly at this point. I think I'm glad it's doing better. Okay. Yeah, Darren, thank you for the comment. And if you love our service, like our service, yeah, please leave reviews online, especially on Copilot, not Trustpilot. And we will appreciate that very much. Again, when you have suggestions or when you have anything you're not satisfied, open a ticket and we will address that certainly. And you can reach us here with this support manual. You can do a chat support. You can create a ticket. If you need help, you can schedule tutorial meetings, one-on-one meetings with us. And of course, you can call, but call is sometimes in the phone we cannot share screens. It's hard to communicate. But yeah, create a ticket. We'll always be there to respond. Okay, and DVN. Let's say Chris is talking about DVN, energy company. Energy is not really doing very well this year, and oil price I think is going down. Yeah, energy itself is always more cyclical. So I actually don't. I think that is a good time to invest in oil company is when the price book ratio is low, and I think this might be one of those times now. Yeah, the price book ratio is low. If you look at this price book ratio, it's actually for DVN, it's at historical low. So maybe it's a good time to invest if you know the industry, if you understand the industry. And let's try ExxonMobil here actually to compare. If you look at the price to book ratio only, if here I also in the meantime show you how to use our chart. And the chart is really powerful. Okay, and yeah, if you look at the price to book ratio last 10 years, and DVN, Devon Energy, certainly has a much higher fluctuation in valuation. But if we remove this, yeah, they're cyclical. They're cyclical with oil, with the economy. Now it seems like it's at the low end of the valuation, historical valuation. So maybe it's time to consider it. I think if you look at the dividend, I actually love to look at the dividend. I think dividend is a very good indication of the valuation as well. If you look at the dividend, of course, a company like ExxonMobil, the dividend It's now at 3.5, which is actually very high. The highest one was during the pandemic. Oil price went to negative. The dividend was at that point was 10%. It's unbelievable. And ExxonMobil has a very long history of raising dividend raising since 1983, increasing dividend almost every year. And so I would say it's good quality, good quality. Okay. Thank you to NY. Okay, Ryan is asking, how do you jump into using most broadly help since some of those have been held for many years? Okay, Ryan, thank you for the question. It's a very good question. If you want to invest in the most broadly held companies, and I would suggest you to use the same weighting, similar weighting as we have here. Here we have for every stock, because many of this, although we started with equal weighting for these companies, but over the years, the weighting becomes very, very different because of performance differences. Since we added Apple, since that in 2012, Apple has gained 17 times. Microsoft gained 17 times. So, but follow the weighting here, and it will be helpful. That's my suggestion. So you don't have to be equal weighting, just to follow the similar weight here. Okay. Okay, Philip, thank you for the comment on the earnings. Free cash flow. Let's take a look again. You talk about the free cash flow of MTY stock as here. Let's take a look. You talk about the free cash flow. Free cash flow, yeah, of course, it's important. Of course it's important. Let's see the free cash flow. Yeah, it's this chart. It seems to be quite constant. The growth is constant, but we did quite some back testing and study before, and yeah, let me show you this chart. Okay. Yeah, let's see the historical correlation of the stock with. Unfortunately, for this stock, MTY, none of the stock price is not correlated with with any of these parameters. It does not have strong correlation. But for another stock, let's say just Progressive. This is under the valuation tab here, and you can see the historical correlation of stock price with other parameters. For Progressive, there's a 98% correlation, and the book ratio has a 91%. So, and operating cash flow has a 95%. So it has very strong correlation with one of the parameters. And then when it does, you can kind of follow that parameter trend. With MTY, we just cannot find any correlation with any of the parameters, the performance numbers. Yeah, free cash flow is doing well. We did quite some backtesting before, and we found that most of the stocks are more correlated with the revenue. That's just what we found. Most of the correlation are with the revenue, and it's not the case for this stock, but that's what we found. And free cash flow, yeah, important, but it seems like it doesn't replace. We need to go into detail to find out where the free cash flow is from. The earned net income is not stable, it's not consistent, but why the revenue, the cash flow is consistent? That's we need to Okay, somehow my membership is okay. We need to. That's something we need to find out. That's that's what I think. Okay. Rafa is asking, what do I think AI spend on data center capex in Max 7? Bubble burst seems to be some time away. Thoughts? Yeah, that's a good question. I thought about that. I thought about that, and I read about that. I do think that yeah, the spending is certainly outpacing the revenue generated a lot by a lot, and but on the other hand, companies like Microsoft, Google, they're very profitable. They can afford that. And the company are in more risk is probably NVIDIA. And NVIDIA, because they rely on a few big customers for most of their revenues. And if these companies slow down their spending, NVIDIA will be impacted a lot, very much. But it's not happening yet. It's definitely not happening at this point. But that's my worry. I would say that companies like Microsoft, Google, they have less risk in terms of AI than NVIDIA. Of course, NVIDIA stock did much better than the other companies for the last few years. Now it's a company with the largest market cap. The data center spending is huge, and I read something about Jim Channels, short seller Jim Channels was talking about the depreciation of data centers. He said that data center depreciation rate is now too slow for the big tech companies. In reality, the data center depreciation should be much faster because the GPUs they buy, the chips they buy, will be obsolete in like 2-3 years, which is true if you think of that. The chips, NVIDIA is keep developing new chips and to replace the old chips. Then what happens to the old chips? And they're not depreciated yet, but they have to be replaced. That can be a concern. But still, for big companies like Microsoft and Google, they have more diversified revenue source, and their growth may slow down some, but they will be okay. I don't know about NVIDIA. I always worry about NVIDIA. Okay, Phil, talk about the gold miners. Gold miners show all overvalued. Okay, yeah. Gold miners, the stocks have been doing really well until recently. It dropped some until recently. The reasons, of course, we all know. The gold prices went up. The gold miners, their stock price is more like a leveraged gold price, because they have a cost of mining the gold. The current gold price is around $4,000 an ounce. The gold miners maybe spend $2,000 an ounce to mine the gold. They have to cover the cost first, but then if gold price goes up, and their revenue, their profit goes up much faster. The miners, gold miners' profit goes up much faster than the gold price itself. That's why this year, even with the recent drop, NEM stock still did better than gold price itself. Of course, it drops faster too. How do we reflect gold prices on this? We reflect the gold prices directly on the revenue the company generated. This chart, actually, the Jeff value chart here, in this case, it's more reflecting the revenue trend of the gold prices, revenue trend of these companies. So the revenue of these companies are directly related to the gold prices. Yeah, that's what we're doing. And actually, the trend for both revenue and book value are similar. So seems like the price will continue to go up, but the market, the stock is already went faster than it should be. So that's probably overvalued and would not do as well. That's what I think. Okay. Yeah, Darren is talking about ExxonMobil. ExxonMobil has good dividend yield. It grows dividend by less than 5% of year. Yeah, thank you for the comment. And let's look at the ExxonMobil dividend again. Yeah, the growth rate of the dividend is slow. The 5-year average is only 2.2%, but the yield is really high. If you're looking for good dividend stocks, we have a list called Dividend Aristocrats. All these stocks have been raising their dividend for more than 20 years, I think, 25 years. And that's here is a list. If you look at the dividend yield, the dividend payout ratio, the dividend, if you want to know how long they have been raising their dividend, years of no dividend reduction we have here. Years of dividend increase we have it here. So if you look at this list, at years of dividend increase, Walmart has been increasing dividend for 50 years. Johnson Johnson even longer, 62 years. If I just sort it. Yeah, okay. Dover increased their dividend for 69 years. Emerson, and I think this is General Genius Parts. Okay, it's a car part company. Increased their dividend for 68 years. If we sort by dividend yield here, AMCR. This is Amcor. I'm not familiar with this company. Global provider plastic packaging. It's just 5 years. Okay. Franklin Resources, a mutual fund company, increasing dividend at 43 years. And yeah, let's see the dividend rate of growth, dividend growth rate also. This should be added to this dividend growth rate. If you want faster dividend growth rate, T. Rowe Price, almost 9% dividend yield and 10% a year of dividend growth. And yeah, let's take a look. T. Rowe Price, a mutual fund company, and it's not doing well. Stock has not been doing well again because, yeah, I think competition from ETFs. It's yeah, stock has not been doing well. The dividend is great, but still, I'm not sure we want to invest in this kind of company. We do need companies that can grow. Growth is important. Let me run a filter among the companies that growing at least 5%. I just filter among those good dividend companies. And also the future growth. I need to look at the future growth. Future 3-year growth. It's here. 3-year revenue growth and earning growth. 3-year future revenue growth. Future growth. Let's see, at least grow 6% a year. I just randomly pick a number. And yeah, then this list will be more interesting. This company has growth and has good dividend yield. The first one is Pepsi. Okay, interesting. First one is Pepsi, and yeah, stock is not doing well, The growth is kind of slow, but the dividend is interesting. Dividend is 4%. Dividend growth 7%. Dividend is close to the historical high. I would say it's something to consider if you're a dividend investor. Okay. If you still have any other questions, feel free to ask me. And we don't have lots of time left. We have only less than 10 minutes. Rafael is talking about QQQ and semiconductor have been doing better than SP 500 last 7 years. Makes sense to invest in this given technology trend. Yeah, the QQQ and SP5 has been doing really well last few years. Of course, compared with SP500, it did much better. This is a comparison of QQQ versus SP500 over last 10 years. QQQ actually doubled the return of SPY. But does that mean it will happen next 5 years? I personally don't think so. One of the reasons is because the tech stock is now really at the historical high valuation and really high valuation. The SP500 valuation is also high, but SP500 has more other industries, which I think will do better when the tech bubble slows or bursts. I think so. And over long term, maybe in next 20 years, maybe it will still do better, but next 5 years, I doubt. I still remember that the year when NASDAQ peaked in year 2000. It takes more than 10 years for NASDAQ to go back where it was in year 2000. And history may not repeat itself, but it rhymes. We all heard about that. Maybe it's doing what it was doing 20-some years ago, 25 years ago. Okay, Philip's talking about Domino Pizza Group PLC. Let's see. Domino Pizza. The UK company. Okay, it's this one. Okay, it's more like this one. It's traded in UK. Okay, stock doing poorly. Yeah, the revenue growing, although it's not growing as fast. It's more like a consumer product. Revenue will grow a few percent a year, but revenue slowed down, growth slowed down, and the profit is kind of not growing much. So it's revenue growth slowed down. So that's maybe why, again, it's like similar to Lululemon. And when the growth slows down, the market will punish it. Over the last 10 years, the stock price is down half. So I wouldn't consider investing in this kind of company. I want something that's that can grow. I'd rather invest in something that stock is going up to. Okay, that's okay. GMAB. Genmab. I don't know about this industry. I don't know. I never heard of stock. Biotech company. Okay, biotech company. It's a biotech company, and the growth seems to be quite consistent. Even the market is predicting good growth. Growth, of course, will slow down some. compare slow down quite a bit from last few years. That's what the market think. The earning doesn't grow as fast as the revenue. Yeah, that's I don't know enough. Excuse me. Valuation seems to be reasonable, I would say, and the profitability seems to be good. Yeah, that's about this stock. Invesco VO. Please look at SP, SPMO, a momentum play. Investing Invesco SP 500 momentum play. I don't know how this kind of ETF invest. I know, of course, QQQ and SPY and VOO, they're straightforward, but I don't know how they invest. So maybe they're investing the more trendy stocks, has momentum in the SP 500 index. Let's see what stocks they own, how many stocks they own. We have here the holdings. We can see all the holdings they have, and okay, it takes a little bit to load up. It owns how many stocks? Owns 98 stocks. Okay, it owns 98 stocks. It's probably owns the stocks that have high are doing well recently. Okay, if you look at this, the stocks they own: NVIDIA, Meta, Amazon, Broadcom, JP Morgan, Tesla. Okay, so actually it owns lots of stocks that NASDAQ owns, including also some stocks that does well this year, like JP Morgan, like Palantir. That's how they select stocks. Yeah, I don't know. I think I would rather invest in SP 500 if you want to do this. If it's trying to follow the trend, the market trend. I don't know. Seems like it has been doing better than the SP 500, but let's look at the longer history. And yeah, seems to be doing better. The difference wasn't that much until last like 2 years ago, until about 2 years ago, because this last 2 years the tech stock is just doing so well, and the trend is so strong, the momentum is so strong. Okay, that's where we are. And okay, let's take a look at last thing. IWVL. No, we don't even have it. Okay, it's a ETF. I personally don't know. I don't know. I can take a look. Value based. Okay, that's where we are. Thank you all for coming, and I will see you again next month, December. It will be December 3rd. December 3rd. And at same time, 1 p.m. Central US Central Time, and see you again next month. Thank you all very much for coming, and wish you good luck. Good luck in investing. Good luck with everything. Keep warm during winter, and see you next month, December 3rd. Bye now.